Well, welcome everybody to the August update from Ellsworth Advisors. Today is September 4th, and today we'll kind of review what's been going on with the market over the last month or so, how the economy is doing, and a quick review of how our various portfolios have fared for the month. And today we'll start off with Cam. If you want to give us a little economic update.
Sure, Kelly. If you look at the headlines are what I'm going to focus on right now. If you look at the headlines over the last month, it's been a mixed bag, and that mixed bag leads to volatility. People love their headlines. So let's start with U.S. and China have recently traded additional tariffs. Bad for the market. U.S. and Japan agreed to a new mutually beneficial trade deal. Good news for the market. The dollar has strengthened considerably over the last couple of weeks, and that's really hurt U.S. exports. Bad for the market. Negative rates around the world. Bad for the market. Good for U.S. inflows. Heavy foreign investment keeping our rates low. Again, bad for rates around the world. Keeps U.S. rates lower, but it's nice to see that we're still considered the safe haven, a position the U.S. has really been in since really post-World War II. Now, one of the biggest concerns that we've seen, and this was a headline from yesterday, is that U.S. manufacturing has declined for the first time in 3 years. Obviously, manufacturing is one of the lifebloods of our economy, and seeing the first decline in that important sector in the last 3 years is a little bit concerning. I have a feeling that a lot of that has to do with the strong dollar. A lot of that has to do with the trade tariffs. A lot of that still is headline noise, but we'll see how that plays out. From an economic standpoint, things definitely do look softer. GDP in the first quarter of 2019 was a very solid 3.1%. GDP for the second quarter has come in at 2%. 2% is much closer to our historical average. A lot of that, again, can probably be retraced to the trade war and its disruption on the market and manufacturing. Fed funds rate now stands at 2.25%, and where 4 months ago it looked like there was going to be absolutely no Fed rate movement this year, we're now looking at another potential cut of 25 basis points in September, might even be another cut in December. So the Fed is really trying to do their job in terms of trying to make sure that if we do go into a little bit of softness, we have more of a slow, easy landing versus a full-blown recession. Gross private domestic investment. So this is investment in the U.S. economy by private capital. So there's corporations down 6.1% in the second quarter. That's a strong sign that businesses are expecting a slowdown. They're starting to pull back. They're holding on to cash. They're delaying capital investments. So that's a little bit worrisome as well. Net exports of goods and services down 5.8% in the second quarter. Again, the strong dollar really makes exports of U.S. goods a problem. Corporate profits, they were down 3.8% in the first quarter, but up 5.8% in the second quarter. Mixed signal. Inflation, it was at 1.1% in the first quarter and at 2.4% in the second quarter. So we've got rates going down, inflation going up. So, it really is tough to get a gauge on the economy. The other thing I'll mention is housing. And what concerns me a little bit about housing is it certainly looks like we are in, I don't want to call it a bubble, but we're in a period of very strong uncertainty. So we have peak home prices, but we have rents coming down in major markets, and the available inventory is growing. That's certainly a sign that the housing market is starting to slow down. And so all of that taken together, Kelly, it certainly appears to the layperson that the U.S. economy is slowing. We already know that the global economy has slowed considerably. The Fed is going to do their part. But just because we have a bit of a slowing, that certainly doesn't mean that we're spiraling towards a recession, that the stock market's going to see a major setback. Quite honestly, the headline this morning was that the U.S. and China now might meet in the U.S. this month.
Another one.
And if that happens, look out, stock market.
Well, Cam, you brought up a lot of great points, and you'll notice a lot of the economic data is kind of a lot of cross currents going on.
Yes.
Something's positive, something's negative. You mentioned the manufacturing numbers came in, was that yesterday or today?
Yesterday.
They're weakening a bit. that is that's being offset by the consumer numbers came in a couple of weeks ago, which were actually very strong. Unemployment's at really low levels I don't think we've seen since 2000 from an unemployment standpoint, and all the different various measures of unemployment were close to the lows in that situation. You have wages are up about 3.6%, and what's happened there is it's really on the lower end of the wage scale where you're seeing the biggest increases. So the consumer's strong, manufacturing slowing down, and some of those numbers, like with the business investment, obviously I think a lot of it is definitely in the trade issues. If you're a multinational company where you're doing business overseas, you may pull in the horns. Where should we build our next plant, make our next investment? If you're doing business in China or sourcing out of China, maybe you're waiting to see to make that investment, or are you changing directions, investing elsewhere for supplying? So you have a lot of different cross currents going on, but the general movement or the general growth of the GDP is still positive. For a recession, you need a shrinking of the economy. We still see expansion, but once again, all these cross currents are definitely, kind of confusing the numbers. And what we've seen through August, September, October historically are the most volatile months. It used to really be September, October. It seems like August has become more volatile in recent years, with maybe a little less volatility on the back end. But we're going in that time frame, especially late summer. You have lower volumes, and what's happening is the stock market's getting pushed around by the headlines. That's for sure. Volumes should start picking up later into September. Then we'll roll into third quarter earnings announcements, which, once again, I think it's going to be a mixed bag. Yeah. You're going to have some companies that did fine, other companies that didn't do as well. Obviously, your import-export related companies are probably going to be struggling a little bit, especially on the export side with the strong dollar. But then again, how strong is the consumer? Will that drive us through? Some of the housing numbers, and I've been seeing those numbers, also. But one of the dynamics going on there is where you're seeing the bigger inventories is definitely in the higher end homes. Yep. What we've seen over the last several years, or really since the crisis in 08, 09, is less building being done in the starter homes, your lower cost homes. That's where there's very little inventory. I have clients, if they're selling their home, maybe it's an older couple moving out of the neighborhood they've been in forever. Okay, how are things going? How are prices selling in your neighborhood? Oh yeah, they're houses are moving quickly in a middle class neighborhood versus your higher end houses are the ones that are sitting. So you're seeing a little bit of shift of where the action in the economy is. Different groups are maybe benefiting or not doing as bad as other groups, but in general, we're still seeing that slow growth. And with the manufacturing side, we've gone, really since the recession, we've seen, 11, 12, and then 15, 16, where we've seen that manufacturing slowdown really hasn't pushed us into recession. So on the economic front, we're definitely mixed signals. The rest of the world is slowing, which probably some of the explanation for lower imports on top of a strong dollar, which doesn't necessarily help the rest of the world, especially if we're reducing imports from China. So, on the economy, we're definitely late stages in the cycle. We're 10 years in. How much longer will it go? Hard to say. The other piece, more importantly to clients, is the economy is important, but what's going on with our money? What's going on with the markets? And you can have a down market with a non-recession. You have a recession without a huge down market. So they're kind of linked, but not perfectly linked. Right. One of the things.
Well, and remember, we're still talking about 2% GDP growth,
right,
on the world's largest economy, a $24 trillion economy. 6 years ago, 2% growth. We just said, hey, very strong, very healthy growth.
But that's what we got most of the time.
We get 3% in there, and we get a little bit spoiled and start thinking that's going to be the norm. And President Trump did promise that with his policies we'd be seeing 3 and 4% growth. Obviously, this China situation was something that really is taking a lot of the steam out of those projections. But still, 2% growth in an economy as big as ours is not bad.
No, it's not much different than what we've experienced over the last several years, beyond the last couple where we've kind of had this increase. From a market standpoint, kind of look at some of the numbers of where we're at today, and I want to put it a little bit into bigger term context. So year to date, and this is through the end of August, year to date, the Dow up 15.14%, and these numbers all come from Morningstar. Dow 15 up 15.14 year to date. The month of August, the Dow was down 1.72%. Once again, the Dow is 30 companies, really your bigger multinational companies. So, they've definitely felt some of the pain from the China issues. The S&P 500, broader based, 500 companies, a little more diversified. You have some smaller companies in there. Year to date, 18.34%, but also down 1.81% for the month. So both Dow and S&P down almost 2% for the month. The developed world up 9.39% for the year. Emerging markets only up 1.86%. So you're still seeing a little bit more pain internationally than what's going on in the U.S. Commodities basically 4.45% year to date, kind of flat for the month. And really what's helped commodities is gold. Gold year to date is up 17.4%. In the month of July, up 7.91%. So in general, a tough month for the big stocks. Gold held things up. With interest rates coming down in July, bonds had a little bit of a pop, but July was not a strong month. Year to date, we're still in pretty good shape.
Right.
Now, with our portfolios, going back to putting things into context.
You mean August?
Or in August.
You said July.
I'm sorry, July, August. It was a quick month. Putting the market performance in context, a lot's talked about from the lows in 2009. The S&P was around 700. Now it's at 2,900. That's a big move. This morning I went back and looked at the charts and went to December 2007. So before all hell broke loose in 08, 09. At that point in time, the S&P was at 1548. So it went from 1548 to today it's at 2906. Or that's basically in almost 12 years, 11 and 3/4 years, we've averaged like 4.1%. So to say the market's wildly overvalued, when we look back over 12 years, really the market's been subpar, which you look at the rate of expansion in GDP for the economy over the 12 years, that's kind of subpar
solid
too. So they've kind of, longer periods, they've kind of run in sync where we haven't had that 3-4% growth to give us the high single digit, low double digit market returns that we've seen in the past. So that gives me a little bit of, I wouldn't say confidence, but putting that in context, can the market do a correction like it did back in December this year? That was a 20% move down, but we've recovered all of it, and now we're back in the black from 12 months ago. We're about even, maybe a little bit further ahead from a market standpoint. But the reality is not a lot has been happening when you look at bigger points in time over the last couple of years. So when we look at returns, like year to date, growth with income, we're up 11.42%. Okay, we made up some ground from a year ago. We really haven't gone anywhere. So can we say there's excesses in the market, that the market's wildly overvalued and is going to crash and burn? I don't see that happening in the short term. And without a recession right around the corner, there's room for growth ahead of us. And it also, if things had got to excesses and we were way up, would we want to start pulling in the horns? Not really. I think what we've done over the last several, really 18 months is kind of gone to a quality slant in the portfolios. And what that's allowed us to do, and what we've really seen the last couple of months is, wow, now we're not taking in the brunt of it like the rest of the market is. So like I said, growth of income up 11.42% year to date. For the month, we were down 0.94, so about half of what the markets were, which is a little disappointing because our exposure is just a little more than half. So I'd say growth with income for the month was all right, nothing crazy. Gold helped. We have a position in gold. Gold was up 7.991%. CVS was up about 9% for us. But we also had some detractors. Cisco was down 15%. So kind of a give and take in the growth with income portfolio. Our price potential portfolio.
In Cisco, that's all headline news right there.
Well, that's
every big tech company got hit.
Technology has not fared too well the last month or so. Yeah. They have not really gotten off the mat yet. So what's happening is your more I wouldn't call them brick and mortar, but your non-tech companies have actually done pretty well. Like within the the price potential portfolio, year to date, we're up 22.96%, so around 22, 23%, pretty solid. for the month up 2.33% versus down S&P being down 1.8. Good month for price potential. Target up 24.84%. Pretty good move there. Estee Lauder up 7.78%. Brown-Forman 7.63. Those were our big gainers in there. And once again, no tech companies there, just kind of our old school consumer companies. The biggest pain in price potential, U.S. Bank was down 7.8%. So that really resulted in good performance from price potential for the month. Dividend yield up year to date 16.26%. For the month, 0.04, so basically flat for the month. Once again, that actually fared better I thought it would because it is your bigger companies, your multinational type companies.
More international exposure.
In there we have Prudential. They got whacked pretty hard, down 19.95%. Pfizer down 7.61%. Caterpillar down 9%, another China story. LyondellBasell, a chemical company, down 7.5%. But what held us up in dividend yield, we have 3 or 4 utility companies. They were all up over 4 or 5%. So a little bit of balance in there, still producing dividends, and continuing to chug along, eke out a little bit of a gain. Our final portfolio, or the one that we always talk about, our small cap portfolio, year to date up 17.78. We've seen that 17% number out of them several times so far this year. We get higher, we get lower, we kind of bounce around. For the month, down 1.07%, so not as bad as the markets. But once again, small cap stocks are going to feel more pain than your larger companies. A lot of dispersion in there. I'm not even going to go through the companies in there because we have a lot of plus double digits, down double digits. Just by the nature of small company stocks, they're going to be volatile. I'd expect the volatility the next 2 months to kind of continue. I like where we're at. I think that quality focus is definitely working. I mean, it showed itself through the month of August, and I think the environment's going to kind of be the same, at least for the next several months. Big picture, I don't think the highs are in for the markets in this cycle. I think we have some highs ahead of us. When they come, who only knows? Cam mentioned, there could be some, trade talks here in the near term future, which, once again, from a headline news standpoint, that is a lot of potential upside headline risk.
Absolutely.
I don't see, beyond normal volatility, a lot of downside from where we're at this point. How much worse will that drive the markets down? I don't think anything that's going to be, unrecoverable. So if in general, expect some volatility. I think we're positioned right, but I think we're also primed for some upside surprises because investor confidence has gotten to some pretty bearish levels, which in the short term tends to be a contrarian indicator. When everybody gets as bearish as they are, that's generally when the market goes up. So I wouldn't be surprised to see some positive movement here, even through the volatility in the next couple of months.
Yeah, I mean, this is, if I think about this 10-year run, we've had some hiccups, we've had some volatility, but this definitely feels like the most bearish sentiment I've seen in the last 10 years.
Well, a lot of talk about recession, a lot of bearish sentiment. The reality over the last couple of years flows into stock mutual funds, stock ETFs for equities has actually continued to go, more money's flowing out of stocks than in. And, from my startings in this business in the early 90s, it usually didn't play out that way going into recessions or major market tops. Typically, it was a lot of money flowing in, you have a lot of exuberance, and then you have the market dislocation, and money just starts flying out. And it comes out of the market, until the market turns and is up another 10, 15%, versus then you start seeing the money flow in. Well, the reality is in the last several years, we're seeing money flow out, which, is a little bit counterintuitive, but it also gives me a little bit of comfort, and comfort's not a good word, but it tells me that we're probably not quite to that top part, that top point where we're going to see a major rollover. So that's kind of the outlook. I think, we need to be prepared for ups and downs, and the key right now is just positioning each individual client's portfolio, making sure we have enough liquidity for short-term needs, intermediate-term needs, kind of a worst case scenario, being protected there. But the other side of it is I think we really need to stay invested, keep an eye on quality, and that should, get us through this next, shorter term, intermediate term period. And I do think we have some upside ahead of us into the end of the year. It should be a halfway decent year.
Well, and what I really like about where the portfolio is positioned is price potential. The one that is expected to be the most aggressive is beating the market. The other stock-based portfolios are basically in line with the market. Then you have a lot of our clients which have significant fixed income in liquid positions. So you blend that all together and you're basically achieving market returns without taking the same kind of risk, with having liquidity on the sidelines to be prepared to move into stocks if we see a change in the market. So I think the portfolios are doing exactly what they've been designed to do.
No, the environment the environment we've been preparing for is basically here. So it is good to see that, hey, we were positioned correctly. But the reality is things continue to shift, and once you think you have it nailed, a new wrench gets thrown into the program. So, we're going to continue to be diligent and adjust accordingly as the environment changes and as we see the economy, if it continues to slow, or there's nothing to say it can't continue. This could be another 15-16 scenario where we go through kind of a manufacturing or a profit recession, but come out fine because of other factors. Right now, the main other factor is the consumer is hanging in there pretty well. Mm-hmm. And as long as something doesn't rattle consumer confidence too greatly, we should be able to eke through it. And we need to see a little bit of we need to see some improvement internationally.
Absolutely.
That will definitely help. As long as they don't drag us down with them, we should be able to hold steady.
And I'll be really interested to see as we move towards the end of the year, especially the holiday season, is shape of the consumer, retailers, where's that retail sales coming from? Is online continue to grow? Boom, 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 boom. Seasonal employees, that's further going to put strain on the less skilled side of the market. So the fourth quarter, is going to be very interesting to see how this market is positioned, how it plays out.
It is going to be interesting, around Christmas, just in watching news stories and so forth. The reality is a lot of the Christmas inventory has already been bought. And is on its way or is already here from China. So the tariffs may not really have an impact on Christmas sales. The question would be, okay, how does that bleed into spring and summer into next year? That's really, that's kind of the wild card. So we may not really see, the true impacts of the tariffs until further down the road. But that also sets us up for probably some halfway decent numbers going into the end of the year.
Absolutely.
So that's really where we're at. Cam, you want to add anything?
No.
It was a quick August, or at least in our minds, it was a quick August. And I'm sure September is going to chug right through September. And we'll see how we fare. But if you have any questions, as always, please reach out to us. We're always happy to talk about your situations and your accounts and make sure we're positioned correctly for any upcoming needs.
Thanks, everybody. Have a great day.
Have a great month. Thank you.